Hello friends. On the show today we're going to talk about two very important terms that are used in real estate. That they're used everywhere, but I want you to know what they really mean. Sometimes they get confused. So these terms are ROI, or return on investment, and cash on cash return. As a single professional, I had debt and no savings after my divorce. I always wonder how I can start investing in real estate to secure my future. I studied programs that gave me all the benefits of investing in real estate. Some claim I could start with no money, but I could not find one that gave me the practical, actionable steps I needed. As a wealth advisor, I've met people that own real estate but weren't ahead financially. They were rich, but they weren't wealthy. Then I finally realized that there was one vital component missing that makes someone become wealthy or not. And on the show, I will reveal what I found and give you the step-by-step actions to start investing in real estate and increase your wealth. My name is ARACELI'S. Let's get started. And today we're going to be a little bit technical. So I want to tell you about two very important terms. You're gonna hear them everywhere, but I want you to know what it really means to you in the property that you're analyzing. And just bear with me, there's not a lot of math here. It's just the concept that I want you to be familiar with. Okay? The first one that we're gonna talk about is ROI. And ROI stands for return on investment. And this particular metric is used mostly for flips. If you are buying a property, renovating it, and selling it, right? And this one is a return on investment is the measure of an investment profitability. So you basically gonna know how much money are you gonna get. And most of the time it's illustrated in percentage. So the ROI, the only thing that is not taken into account is the length of time. For example, you bought a property, you renovated it, and you sold it, and it took you 6 months. So the ROI, let's say it's 10%, so 10% you did it on 6 months. However, if you have another property that you bought, renovated, and the same property, now it's taking you a whole year, and it's also the numbers work out to 10%. So which one is better? So both of them gave you 10% return, but I would always go for the one that has shorter term. So that's the only drawback on ROI. That's the only thing that it will not give you. But it's a really good measurement so you can see how profitable was that project, okay? So there is another, and I'm gonna give you an example on this. So let's just assume that we're buying a property for $400,000. And it requires $100,000 renovations and everything that we are putting into the property for a total of $500,000. So the total cost that we put into this house is $500,000. Now we turn around and sell it. Like in this case, we don't take a look at how long it's taking us. It could be 6 months, a year, it doesn't matter. So we sold this property for $600,000. Now our net profit would be the total sale price minus the original cost. In this case would be $100,000 net profit. So from that, we're gonna have, and the formula to calculate the ROI is net profit, or net return that also is called, divided by the original cost. And if you do it times 100, it's just to make it into a percentage. So in this case, we have $100,000 of net profit divided by our original cost of $500,000. So this particular project is going to give us a 20% return on investment. Okay, great. So I hope that is clear. Now I'm going to talk to you about another metrics, which is the cash on cash return. And a lot of people really confuse ROI with cash on cash return. And both of them are very different. In some cases, actually, they will use interchangeably, which is not true, is not correct, because both of them will give you a totally different matrix. And cash on cash return is normally used for a commercial property, something that is going to be that you're going to keep for the long term, and that is something that is going to give you rents, right? And this is used mostly to measure the performance of the asset that you have. Okay, and this one will take into consideration some different numbers, and as the formula says, it's cash on cash. So therefore, how are we going to calculate cash on cash return? It's going to be the annual pre-tax cash flow divided by the total cash invested. Okay, so this is again, cash on cash return would be the annual pre-tax cash inflow with the total cash invested, or the outflow. Okay, so it's very, very simple. Now let's discuss what it means to have the annual, what is included in the annual pre-tax cash flow. That is, it contains, it's a two-part formula, okay? So the first thing is all your rents, your gross rents. That means if the tenant pay you $1,000 a month, then your total gross rents would be $12,000. So $1,000 times 12. And then you are going to add any other income that the property generates. In this case, let's say that you have a washer and dryer that are coin operated. All that money that is generated through the year, you got to add it to this. And then the final step is to deduct three things. So you're going to have the vacancy. So if your property wasn't rented for a number of months in that year, let's say you have a vacancy of 2 months. So now you have to deduct 2 months rent. In this case, we said it's $1,000. So that means you're gonna put $2,000. Now let's go into the operating expenses. The operating expenses is what it costs you to maintain that property per year. And it is different for each one of the properties. Most of the time, what you're responsible for would be the property taxes. In the case that you have a condo accommodation, that probably the condo fees would be included in the operating expenses. Now, if you do have a duplex or a triplex or a fourplex that have multifamily units, in that case, you may be responsible to pay for the heating, sometimes the electrical, maybe the garbage removal. In a single family home, normally the tenant would pay for everything, for all the, not for everything, but for the utilities, which it would be the gas, the electric, and everything else, right? And they will take care of removing the garbage. But with a commercial property, there's, 2, 3, 4 units, you may have to do it yourself. So that expense has to be added in here. And the last thing that you need to add is the mortgage payments. So whatever your mortgage is, if it's $1,000 or $2,000 a month, then you have to multiply it by 12. Okay? So then again, the annual pre-tax cash flow will be composed of the gross rent plus other income, and then you're going to subtract the vacancy, the operating expenses, and the annual mortgage payments. Okay, so let's have an example here. We have a property that was bought for $1 million, and the owner, we put down $100,000 as a down payment, so that's 10%. We got a mortgage for $900,000. And we also had to pay the closing cost. We paid that cash as well for $10,000. Now, after 1 year, we have received $2,000 a month in rents, which is a total of $24,000 in that year. But now we had to pay the mortgage payments that cost us $25,000 a year. And our operating expenses, that was the property taxes and some of the utilities, it came out to $5,400 in the year. Now, this particular owner decided to sell this property after 1 year. In most cases, this is not going to be the case, but I want to illustrate it as if it was sold after 1 year. And after 1 year, he decides to sell it for $1.1 million. So he got $1.1 million. And now out of the loan payments, so the payments that we did throughout the year, it was $25,000. But out of that, only $5,000 were going to the principal. So the total mortgage left at the end of 1 year was $895,000. And the property was sold for $1.1 million. So the total profit from the sale is going to be the difference between what we owe, what we sold it, and all the rents received. So if we do the calculation, first of all, let's look at the cash outflow, what it cost us. And remember, this is cash that we had to put out our pocket. So the cash, the down payment, the closing cost, the loan payments or the mortgage payments monthly, and the operating expenses all came out of cash. So this is a total of $140,400. Now, if we go to the inflows now, so first of all, let's calculate the profit. So we sold it for 1.1, and the mortgage that we owe is $895. So the difference between that is $205,000, and we received $24,000 on rents, and that was it. So the total cash inflow from this is a total of $229,000, which is the 205 minus the 20 plus the 24,000. So if we calculate the cash on cash return, now we're gonna have $229,000 minus the 140,400 divided by 140,400, which is the total cash outflow. This is going to give us a whoopee 63.1 cash on cash return. So this is completely different, and you'll see that because I am going to illustrate what would be the difference. What would be my outcome if I just do the calculation as an ROI, or return on investment. So as return on investment doesn't consider the rents, because I don't know in this case, right? We only have these numbers. The property was purchased for $1 million, and that includes maybe all the renovations, right? So that's the total investment that we're doing. I don't know how much this individual is putting in for down payment. It could be 100, it could be 200, 300,000. It does not matter. It's just what was the acquisition price. It was sold for 1.1 million, so therefore my net profit in this case is 100,000. So if we do the regular ROI, or the return on investment, that would be $100,000 net profit divided by my original cost, which is $1 million. In this case, I only have a rate of return of 10%. So this is really just a rule of thumb if you don't have any information. Also in this, if I'm just looking at those numbers, it doesn't tell me how long it actually took me to get this 10%. Normally we factor in the return on investment on an annual basis. So that means that if I have these numbers, but it actually took me 2 years to sell this property, then my return will come down by half, right? Because it's 10% annually, but because it took me 2 years, now it is 5%. So that's one of the things that I want you to think about, to consider, and that get familiar with return on investment, or ROI, and cash on cash return. So two very different matrices, but you need to be familiar with them. So that's it for today. Thank you for being here on the show. Please remember to subscribe and hit the notification bell to get notified when there are more shows available. And if you would like to have more information on how to start investing in real estate, please visit my website at www.aracelihernandez.com. Thank you.